Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is After the Close. I'm filling in for Barb Armstrong today, but boy, what a last 24 hours we've had. Yesterday, the eyes of the world turned to Fed Chairman Jerome Powell. Let's see what wisdom he has for us. Everybody in hushed silence waited to see what he had to say, and he said, uncertainty is unusually elevated. What does that mean? Well, that means we don't really know what's going on, and this time we really don't know what's going on. At least that could be one interpretation. And when you heard that, let me ask for your honesty here. How many of you might have said, "Samesies, yep, sometimes I look at the markets and I don't know which way it's heading." Now with the Fed, they took that information and their course of action from here forward was no change in the course of action. But is inaction all that's left to a trader who can't make up their mind regarding which way they think the markets are likely to go? Well, today we're going to be talking through a strategy that some traders might turn to when their own levels of uncertainty are unusually elevated. I think it's going to be an interesting discussion. We're going to be talking about something known as a long straddle trade using options. But before we can get to any of that, let me first of all say hello to everybody out there who's joining us out on YouTube. Great to see Will and Greg, Tatiana, TMTM, Brown Buffalo, Villager, David, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. We launch it right at closing bell, so 4 o'clock Eastern. If you'd like to be here in the live stream audience, it'd be great to have you. And for our live stream audience members, we also have a special treat. My very good friend James Boyd is hanging out in the chats. He's going to be addressing any questions that I can't get to, as long as we're not getting too far off track. If the questions are on topic and I can't get to them, James is there to pick up slack for me. So thanks for having my back there, James. And James and I would also like to issue an invitation to everybody within the sound of my voice. If you have an account with X, you should be following your favorite presenters on X. It's the best place to connect with them in between these live streams. So you can find James there on that platform at James Boyd CS. You can find me on X at Cameron May CS. But let's get into this discussion of a strategy that might be employed when uncertainty is elevated. So as we do, of course, we need to consider the risks associated with trading and investing. They certainly apply to option strategies. So this is important information. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risk, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's lay out an agenda for how we're going to spend our time together. We have up to 45 minutes to spend together today. So I wanted to talk about how an option trader might deal with uncertainty. So the first thing that we're going to do is just go back over the last 24 hours, talk about the news that we got yesterday, some of the news that we got today. And then we're going to go have a look at the market's reaction to that news, looking at the S&P 500. And as we look at that chart, we're going to put ourselves in the shoes of traders who might find themselves in sort of a quandary, highly uncertain decision that might be made on the S&P 500 for some. But then we're going to talk about a strategy that some traders actually recruit at times when they suspect the markets may go up, the markets may go down. How might we take advantage of either one of those directions? And that's going to be our discussion of a long straddle. So, Greg, we were discussing this before the webcast started. Greg's calling out the color of my shirt. It's a red shirt. It's actually rust colored, just so you know, if that takes the pressure off. Anyway, yeah, let's go right to the Thinkorswim desktop trading software platform. And we'll just park it right here on the chart of the S&P 500 and talk about some of the highlights, at least as I saw them, from Jerome Powell's address yesterday. So just to bottom line it, and not too much surprise to anyone, the Fed didn't make a change to their target funds rate, still at 4.25 to 4.5%. But then Jerome Powell did have some interesting things to say about inflation and about economic growth prospects. So there are a couple of battling influences out there. Obviously, they're not the exclusive influences on where inflation may be headed from here, but the inflation expectations were actually dialed up from 2.5% to 2.7% through the end of 2025. So the Fed is looking at a little bit greater inflation, obviously their target being at 2%. But what might be driving that inflation? What do you think? Go ahead, throw in a one-word answer. What do you think is a likely driver of inflation right now that lots of eyes are tuned to at the moment? Yeah, tariffs. Tariffs, big headline-making word at the moment. Well, in the Fed's interpretation, speaking of a big headline-making word, I think this sort of set a bunch of people aback when Jerome Powell recruited this word again. But yeah, one of the drivers of inflation are tariffs. When we raise prices on potential suppliers of goods, even if they're overseas suppliers, that can drive the price of those goods higher even domestically. That's what we call inflation. Now, the Fed recognizes that potential influence, but they said, the inflation effects are likely to be what? They didn't say short term. They didn't say short lived. They said transitory. Can you believe they used that term again? Transitory. I think it caught a lot of people off guard that they would go back to that, because those of us have the memory stretching back more than a few months know that word was used, and not very effectively, a few years ago. Anyway, so the impact of tariffs on inflation may be transitory. Well, on the other side of that coin, we have the same administration taking other efforts also to reduce federal spending. There are lots of cuts. We're hearing a lot about those cuts. And if spending is reduced, that has the opposite impact on inflation. So we'll see which one wins in the long haul. But for now, the Fed sees projected inflation a little bit hotter than before, not too far above the target rate, but that may also mean they may be a little bit reticent to make aggressive cuts. All right, that might spur the economy. It might drive higher inflation when we're already floating still above inflation targets. So the Fed is looking at possibly 2 cuts through the end of the year. There's still some. It was interesting to read speculation. Maybe 3 cuts. Now that's not been the FOMC's stated position or outlook. So time will tell. So interesting things happening on the inflation front. As for growth projections for the economy, they actually dialed that down. Economic growth was dialed down from 2.1% to 1.7%. That's not recessionary, but still slower growth. Now that's some of the things, the highlights that we learned yesterday. Sort of with the exclamation point of uncertainty is unusually elevated. I thought that was, I need to remember to say that the next time I don't know what to expect. Well, uncertainty is unusually elevated. I like the term. Anyway, but then today we got some additional economic news. Oh, by the way, I should throw in, the Fed's also expecting unemployment to possibly creep up. But those unemployment numbers, that initial claims for joblessness, were actually a little bit stronger than anticipated. Still hanging out there at pretty low lows, 223,000 claims for unemployment, whereas the expectation was 224,000. And then one other thing that we might keep an eye on, I'm not going to be here to do another after the close tomorrow, but what's happening tomorrow, you options traders? That may introduce some uncertainty and some volatility to the markets. It's triple witching. Triple witching means, if you're not familiar with it, 3 things are happening at the same time. We have the quarterly expiration for equity options, equity index options, and equity index futures, all expiring at the same time. That can create a lot of volume, a lot of volatility, and that can contribute to uncertainty. Yep. So with that as sort of the news backdrop for what's happening with the S&P 500, let's look at the S&P itself. And I wanted to look at it through two different competing lenses, one that's primarily bullish, the other one's primarily bearish. See which one of these two you might relate to. First of all, we have this sell-off on the S&P 500, 10.5% from recent highs, taking us down to a possible trend line. So for some technical traders, they might see this as, oh, well, this is just the natural breathing in and out of the markets. We've had a 10% correction. It happens about every year or two on average, and here we are right on schedule. I think it's been about 20 months since the last one. But we've had a 10% pullback, and that's taken us right down in line with recent retracements that signaled, on the last couple of cases, a strong recovery to the upside. Look at that. And could we be in the early stages of that recovery right now? So for some traders, they may see the potential for rapid increase in stock prices. Someone else, though, looking at it through a different lens that we discussed in a webcast that I did just a few hours ago, they may look at this strong selling off and this apparent recovery. Boy, that's early. That's still a tale yet to be told, but for some, they may look at this instead of being a sign that we're likely to go higher. They may see this as what we call a dead cat bounce. Somebody else called it a bear flag. Those two technical price patterns share a lot of similarities. One thing that might disqualify this as a bear flag is that a bear flag is a continuation pattern of a bearish trend. There was not a bearish trend leading into the initiation of this move. So that, in technical terms, would disqualify this as a bear flag, but it wouldn't necessarily disqualify it as a potential dead cat bounce. So let me just remove this drawing. Dead cat bounce just means that we fell really hard, getting a little bit of bounce off of a support level, as maybe there's a few bargain shoppers coming in trying to get deals, and then the momentum is likely to carry it down again. So for those traders, they may see this as likely to continue downward. So here we find ourselves. Do we think that a technical trader who has the training to be able to see both of those things, there's a hint of bullishness, there's a hint of bearishness, as a matter of fact, more than just a hint in either direction, we could be setting up for an explosive move to the upside, could be setting up for an explosive move to the downside. Do you think we could relate samesies with Chairman Powell and say uncertainty is unusually elevated? Well, at times, when a trader thinks that uncertainty is unusually elevated, they may want to leverage that into potential profit. And as I've mentioned a couple of times already, there is a strategy that some traders turn to. Not everybody does. This is just an educational discussion. But some traders will turn to something known as a long straddle. How many of you are familiar with a long straddle? It's kind of a weird strategy in the eyes of a lot of people because it involves buying two diametrically opposed options contracts and letting them duke it out. We're going to buy a call, we're going to buy a put on the same stock, same price, or same time, same expiration, and just let them duke it out. Greg, you say that you're familiar with this, but you've never used it. I think you're probably not alone in that. But I want to switch things over here. Let's go to an individual stock that may be in a similar technical scenario. Life in the fast lane, so it says familiar and used. Well, I'll bet life in the fast lane, you may be able to attest to this. If we use this a lot, here's what the trader needs to be prepared for if we're using long straddles repeatedly. And that is, it is a low probability, high reward potential trade. So a typical trading career, if someone were to just trade long straddles over and over and over again, there are going to be lots of little losses, lots of little gains, lots of little losses, lots of little gains. And then every once in a while, boom, we get it just right and it can make a lot of money. But it's a strategy that can require some patience. But with that said, let's bring up Morgan Stanley, MS. So here's what a technical trader might find as interesting with Morgan Stanley. Morgan Stanley has been getting up and moving, either up or down, up or down. And recently we've been rising fairly rapidly, taking us up right about to $120, which has been a possible important tipping point for price. Sometimes from 120 it's gone up rapidly, from other times it's come down rapidly, but that's a possibly important area of support and resistance. Mike says it sounds like a heart attack strategy. Some traders prefer strategies that carry high reward potential, and they're willing to sit out a series of small losses just to get that reward. It's kind of like, to use a baseball analogy, you have some players who like to take the safe little hits, and they try to increase their batting average by getting on first base as often as they can. Other players just like to swing for the fences. They strike out a lot, but boy, when they connect, home run, right? Sorry, it's a sports analogy. Not everybody does sports. I actually am not a baseball fan, but at least I understand the analogy. But in any case, let's put ourselves in the shoes of this trader who's looked at the markets. They heard what Jerome Powell said. They feel that uncertainty is unusually elevated, and that can carry some potential. Because if, let's say the stock does make a sharp move upward over the next 30-ish days, if we buy a call and it does that, that call can make a lot of money. As a matter of fact, a call has unlimited upside potential. On the other hand, if we run into this resistance and it drops sharply downward, back down, let's say closer to 100, could go further, and we own a put option at that time, that put could make a ton of money. Joseph says, did my first straddle today, never thought of a long time frame. Yeah. Anyway, yeah, longer time frame. With this trade, we're probably going to do like a 60-day trade as our example today, but not everybody does it in that time frame. So which one should we do? We could make a decision. Buy a call, hope that it goes up. Or we could buy a put, hope that it goes down. Or maybe we just buy one of each. Because if we buy a call and we buy a put, and then the stock makes a strong move in one direction or the other, well, if it goes up, our call can make a ton of money. As a matter of fact, it has an unlimited reward potential. What's it going to do to the put at the same time? It's going to kill it. It's really going to damage that put, but the put can only lose so much. We can only lose as much as we invested in that put. So unlimited upside on the call, limited downside on the put. At the same time, if the stock drops, that can make a lot of money for the put, while the call can only lose its invested value. Now, that's the basic concept here. So let's go talk about the pros and the cons of how this trade might be done. First thing the trader might do is look to see, well, how long do we think it might take to make a run in one direction or the other? And when Morgan Stanley gets a mind to get up and go, these $20 moves look like they might last a few weeks to, in this case, maybe up to 6 weeks. Now, commonly, the moves to the upside are slower than the move to the downside. So when we get a big move down, that looks like that only takes maybe a couple of weeks. Well, so let's say that the trader thinks, oh, let's sort of average it. Let's say that we think it might take a month. Well, if we're going to go buy these contracts and let them duke it out for a month, maybe we don't want to run out of time right at the end of that month. So the trader might double the amount of time that they buy. So a 30-day intended trade, maybe they buy a contract for 60 days. Joseph says, is it not common to go over 60 days? A trader could. What would be the advantage of doing that? Well, it allows the stock to make even larger moves conceptually, up or down. That's the pro of going longer term. The con is it costs more to do it that way. For some traders, they may do a very short-term trade where they think the stock, it's about to just have a big explosive move in the next week, and they buy a shorter-term set of contracts. As a result, well, that costs less money, awesome, but also there's not as much time to benefit from strong moves, not so awesome. So there's not a prescribed time frame. It really just comes down to how long the trader thinks it's going to take to make a move. Now, before we go put this trade together, for some traders, since the objective of this trade, and actually it leans heavily into uncertainty. The entire premise of the trade is uncertainty. The trader might actually want to dial up that uncertainty. Does anybody spot something on the chart right now during the intended time frame of this trade that could serve to crank up the heat of uncertainty, could cause the stock to go up or down even faster. What do you think? Mike, you like this? But what could spur the stock even faster? Well, look right here. Just a few weeks out from our intended entry here, there's an earnings announcement. Earnings can go well, or they can go poorly, or they can go just sort of normal. I got to tell you, with what we're about to do, the worst case outcome is for the stock to do nothing. That is not what we want to have happen. What the trader really wants here, for the strategy, go up or go down, just go. Going sideways, terrible. All right? Yeah, but Kevin and David and Nirmal and Life in the Fast Lane, Brown Buffalo, High Speed, Low Drag, says their earnings right out here. Now, David's actually going outside of just this company and looking at, oh, there's also still an ongoing discussion of tariffs. Could that unsettle this stock further in one direction or the other? It certainly could. There are other influences. It's just that some, we can see them coming. And that one, we can see it coming. So I'm going to go structure this trade. So let's go to our options chain. Here's a 28-day contracts. Let's go out here to the 57-day contracts, about 2 months. That's going to be the 16th of May. Let's open this up and let's put together, for some of you, it's going to be the very first demonstration of this thing known as a long straddle. So this is the way it works. Very commonly, the trader just looks at the current price of the stock, and right now Morgan Stanley is trading very close to $120. So we look at our strike prices and we go to that 120 mark, and we're going to buy a call and buy a put at the same time. Looks like both of those are going to cost about $6. Now, there's actually a subtle bias that's going to be built into this trade, because the call is actually going to be a little bit more than $6, very likely. The put is going to be a little bit less than $6, very likely. So if we're spending more on the call than we're spending on the put, it's going to tilt the scales a little bit toward bullishness on this trade. It is going to have, since we're going to have more at risk with the call. We literally going to invest more in it, so there's more at risk there. We would call this a long straddle with a slight bullish bias. Still means trade could work out just fine with a strong move to the downside. It's just that it's going to have to travel further to the downside to make up for the expense of the call that can lose money because of that downward move. All right, but Stephen says, do you trade for the filling of gaps? That's another technical technique that might be applied in the planning of a trade like this. If a trader's sitting, like, let's say it's right on the precipice of a huge gap, and it could either break into that gap and hopefully go up and fill it, or if it bumps its head, because remember, with gaps, the assumption isn't that the gap is going to fill. It's that if price enters the gap, then the expectation is it's likely to fill. But the initial assumption is the gap can act as a form of resistance or support, depending on whether we have an upside gap or a downside gap. But yeah, let's talk about putting this trade together. So let's open up our scratch pad. We drag this down, and this is going to be our example trade. I don't like that it's not bolded. Let's bold this. Bold that. Example trade. There we go. And this is a long straddle. I'm going to explain the naming here in just a moment. But it really is just a pairing of a long call and a long put. So we're going to buy the 16th of May, 120 call. And that looks like it's, right now, and the markets are closed, so we don't know how much we'll pay for this call if we're able to get it filled as of the open tomorrow. Might be more, in which case the put would likely be less. Or tomorrow, we may have to pay more for the put and less for the call. But let's just say that we're buying this for $6, and let's just split it right down the middle, $6.25. Now, at the same time, we're going to buy the 16th of May, 120 put for, let's call it $5.70. Somewhere, $5.60 to $5.80. We'll call it $5.70. So you can see the call is a little bit more expensive than the put at the moment. But from here, the trader really needs to know what they've gotten themselves into. Let's do this. Let's put this trade on. So a quick way to do one of these trades, we can come up here and choose straddle. Well, and as we do that, let's talk about the naming. Why not? Why do we call this a long straddle? Now, let me go back here to our single strikes again. Well, it's because we've selected a stock price, 120, and you notice the calls are on the left and the puts are on the right. It's kind of like when you straddle a horse and you put your left leg in one stirrup and you put your right leg in the other stirrup, but they're in the same position relative to your body. We're not up, like that. Anyway, yeah, we're straddling price on the upside and the downside conceptually, if you can envision that, or left and right, however that paints the right picture for you to remember. Anyway, so it's known as a long straddle because we're buying, and in trading or investing, when we buy something to initiate a new position, we say that we are long that thing, long the stock, long the option. When we sell something to initiate a new position, we say we're short that thing. So this is a long straddle, buying a call on one side to put on the other side. Okay, but how do we place the trade? Well, we can come up here, change this to straddle, and then just find our straddle here, 120 and 120, and then just click on the ask price. It doesn't matter whether it's on the call side or the put side. You'll notice they're going to be exactly the same. The bid's at 1170 here, it's at 1170 over here. The ask is 1220 here, it's 1220 over there. So we just click on one of those, and that creates an initial buy order. By default, unless you've changed your settings for your Thinkorswim, it's going to be for 10 contracts. Now you'll notice it looks like it's going to cost us net about $12. That cost is coming from buying this and buying that. The combination of $6.25 and $5.70 is getting us to about $11.95. Why don't we just say, let's say we're willing to spend 12 bucks to get into this. All right. And let's dial this down just to keep the math nice and simple. Let's just do one contract. So if we do that one contract at $12 per share, these are standard contracts, 100 shares represented by the call and the put. This would be a $1,200 investment. But for that $1,200 investment, we now know that through the 16th of May, we have the right to buy shares if we want them for 120 bucks, or sell shares if we want to for $120. So how about let's place this trade. Now, I don't do this very often. I think I have the time though. I think for some people, they like to see the Analyze tab. How many of you like to see that, what we'd call the risk profile, the profit and loss scenario on a chart? Well, if we want to see that, we can right-click before we submit our order and analyze this trade. And that brings us up to this risk chart, which has a green line, which is just showing us how our trade might do at expiration, depending on whether the stock goes up or down. So David says, do some straddle traders use the market maker move in their trading plan? They can, David. I don't have time to dive deeply in the market maker move, but it's a good question. Yeah, they might. But Tommy and Ron, Timeless Classic, you like to see this tool? Yeah, so if you're not familiar with this, it just has potential for profit or loss on this y-axis, or the vertical axis, and then it has potential price levels on the bottom of the x-axis. So right now we're trading right around 120 bucks. So this gives us a vertical line to represent where we are right now. And then if the stock goes down, what happens to the potential return on our trade? It goes up. However, notice where our break-even point is on this trade. Even if we're going up, our put is doing well. What's happening to our call though? Stock is dropping in value. The put's doing well. Call not doing so well. So we're actually still below break even. We actually hit a point $12 below, because remember we're paying 12 bucks for this. $12 below where we are right now is where this trade would conceptually break even at expiration. $12 above where we are right now basically is break even at expiration. So the stock needs to get up and move. Can you see why the trader would lean into uncertainty? We need this thing to make a big move. Now, is there some likelihood, Craig, you say you're learning, you've never done a call or a put trade? Okay, well, welcome, Craig. Great to have you. I always hope that everybody can follow along with my discussions. I try to go at a level that everybody can follow, but if you are brand new to options trading, you may want to check out our webcast series. It's called Getting Started with Options. So do yourself a favor. If you're not subscribed to our Trader Talks channel on YouTube, make sure that you've done that. The full name of the channel is Trader Talks Schwab Coaching Webcasts. But you can go to YouTube and find our playlist for previous webcasts right here. You can also join the live webcasts as they come up. You can see, which ones are coming up. Just right down below, you'd see the upcoming live streams. But the one that you may want to look for is called Getting Started with Options. And you can either watch that live or you can go to the playlist. I happen to teach that webcast series. And if you scroll right on down toward the bottom, and you're actually going to be looking for Barb's face. Barb used to teach this webcast series. I do it now. But if you go to the View Full playlist right there, I actually put together a series of 10 lessons for somebody that's brand new to trading. So Craig and anybody else that might be brand new to options, this just starts off with the basics, the building blocks of every option strategy. We learn those first and then move on, okay? Anyway, let's go back here. But my point in bringing up this risk profile is the stock needs to move. The most probable outcome is that we don't move enough. Yep. The most probable outcome is that we don't move enough. So maybe the stock goes up and the call's doing okay, but the put has lost its value. Or maybe the stock goes down and the put's doing okay, but the call has lost its value. And the put's also taking some damage from time decay. We really do need to get a pretty good move in one direction or the other. So this is not a high probability trade, but once a stock gets going, remember those $20 swings we saw in the stock? They're not uncommon. A $20 swing could turn this into a highly profitable trade. So yeah, this is a sort of strategy where the trader needs to be prepared. Most of the time, we're gonna suffer losses to some extent, usually relatively small. Now, there is a way that we could lose the whole investment, because if the stock goes down, we're not going to lose the whole investment in the put. If the stock goes up, we're not going to lose the whole investment in the call. How do we lose the entire investment in both? That's actually extremely unlikely, but it can happen. Well, let's go back to our contracts again. Let's suppose the stock it doesn't go anywhere. We're at right around 120 right now on day one, and then come day 50. What did we have? 56 days? Yeah, Tatiana says, if the stock doesn't go anywhere, despite the uncertainty in the markets right now, despite what Chairman Powell said, despite the fact that we have an earnings announcement coming up, despite the fact that we have tariffs that are uncertain, all the things that could cause the stock to go up or down, let's suppose it doesn't do anything. And it's worth 120 bucks at expiration. Well, awesome. I have the right to buy shares at 120. There's no advantage over just market prices. I also have the right to sell shares at 120. That's no advantage over market prices. And in both of those scenarios, we would have lost the full value of those contracts. So staying at 120 is the worst thing that this trade could do. Moving big away from 120, that's what we want. Moving down here, great. Moving up there, awesome. Staying right here, the worst. Okay? So let's place our trade. I'm going to click confirm and send. We're going to attempt, I have to say attempt because I don't know if this order is going to fill or not tomorrow. Time will tell. We're going to try to buy a straddle, the 120 call, the 120 put, $12 limit. That's to open a new position. Notice that tells us our investment on one contract on each side, 1,200 bucks. That's how much we could lose if the stock lands right at 120 at expiration. Also, if we get a strong move, there's an infinite profit potential with this. That's because of the long call that we own. Because a stock can go up and it can keep going and going and going and going, and that can be better and better and better for our call. Sure, probably wiped out the put along the way, but the call can keep making an unlimited amount of money. If the stock falls, it can make a lot of money. This option, the put can make a lot of money. Doesn't have infinite potential though, because a stock can only fall so far before it smashes into earth, hits zero. So yeah, it does have infinite profit potential. Now, this is showing no commission. There is typically a commission on an option trade. In any case, and let's just send that off. I don't know in this account. Yep, there we go. There we go. We put that in. So we're going to see how this goes from here. But guys, this is a strategy that some traders turn to when they are when they're attempting to optimize uncertainty. Pretty interesting. Let me check the question, see if I'm missing anything in here. Truth will always prevail, says a strategy will probably work better with highly volatile stocks that moves fast, quickly in either direction. There's some truth to that. Yeah, truth will always prevail. One thing that we have to be aware of, though, if the stock is already volatile, its options are going to be more expensive. Yep. So that's a trade-off. The potential carried by those options is greater, but everybody knows that, so you have to pay more for that potential. Josh says, I like straddles on low volatility environments. Very interesting, Josh. Yeah. So for some, so what Josh is saying, he might be looking for the calm before the storm. Would that be accurate to say, Josh? Do you think some traders might be looking for stocks that are usually volatile, but they've gotten kind of quiet? Yep. That's not an uncommon approach, to look for stocks where the volatility's kind of bled out for a while. What that'll happen, what that'll sometimes cause to happen is it will lull the options buyers, the other options buyers, not into a sense of security, but into a sense of boredom. When options buyers get bored, they go looking for something else. It brings the price of the options down. But when a traditionally quiet stock, a traditionally volatile stock gets quiet, a common expectation is the volatility should return in the future, and that may open up a short window of opportunity to buy options inexpensively, buy an inexpensive call, buy an inexpensive put, and then when the volatility comes back, boom, that's where that potential comes from. Yeah, okay, good observation there, Josh. In this case, we are not buying inexpensive options or at an inexpensive time for Morgan Stanley. Morgan Stanley has not been quiet, and we have this foreseeable in the fact that we can see it on the calendar. We don't know how it's going to go, but there is an event that's typically associated, it's commonly associated with enhanced volatility. Yeah, the options right now on Morgan Stanley are likely, in a historical context, kind of pricey, but there's another tendency among options values as we go toward, as we get closer and closer to an earnings. Very commonly, they get even more and more expensive. That's actually good once we purchased. So we'll see if that happens. But guys, we've accomplished what I set out to do today. I thought Chairman Powell's comments yesterday, let's call him Jerome Powell. I get somehow uncomfortable saying Chairman Powell. Okay, let's call him Jerome Powell, but or Jay Powell, should we just say that? Anyway, his comments yesterday were interesting to me. Uncertainty is unusually elevated. Immediately I thought, hey, you know what? For some traders, when uncertainty is unusually elevated, they look to straddles. So, Greg, I'm glad you liked that session. Truth will always prevail. You're certainly welcome. Tatiana, thanks for giving me your time today. Everybody, thanks, for joining us today. I'm going to let you go. Remember, Barbara will be back to teach this again next week. But between now and then, make sure that you're taking advantage of all the resources that we offer out there. First of all, starting with make sure that you're subscribed to our Trader Talks channel. You can go down, click on the subscribe button right now. It only takes a second, it doesn't cost anything, but that channel is where you find all of these archives. So again, here's what you're looking for. You go to YouTube. If you can just find the page, the homepage for Trader Talks Schwab Coaching Webcasts, and that's where you can find the playlists. You can join the live streams. You can do searches for using key terms. You can search our channel for topics of specific interest to you. Also, make sure that you're following James and me on X. If you have an account with X, give us a follow. That only takes a second. That doesn't carry an additional cost, and that's the best place to connect with James and me and other presenters in between the live streams. You can find me, just so you know, this is the guy you're looking for. Different colored beard at the time this photo was taken. Have that as my backdrop. Make sure that you use our precise handles here. Social media has lots of very similar handles. Similar doesn't work. It has to be exactly the same. So at Cameron May CS is my handle. At James Boyd CS is James's. All right, everybody, go have a great day. Thank you to everybody that's already clicked the like button or the thumbs up button. I can see 34 people have already clicked that thumbs up. That's always appreciated. Sounds like applause to me. And it also gives my webcast a boost in the YouTube algorithm, helps more people find these discussions and learn things like, what do we do in uncertain times? What are some strategies that might be employed that actually embrace that sort of uncertainty? So I'll see you in a future webcast, everybody. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.